huge piece of news, Kartik, coming in for startups in India as far as their angel tax calculations are concerned. Let's remind viewers here at this stage that the Finance Act Amendment of 2023 allowed for angel tax to be calculated on the premium of that you're paying for a share for those investing in Indian startups from overseas as well. Until that amendment came in this year, there was no angel tax on anybody investing in Indian startups from, say, Dubai or Singapore or anywhere. Yeah. But now that exists. But the latest on that front is that the methodology for the calculation of the fair value of a startup's share. That's where the huge bone of contention was. There was a draft in which about 5 methodologies were given. Finally, now we know, basically, at the end of the day, we now know how to calculate angel tax according to government's rules. Government has given a clarity on how to calculate angel tax, given options of 5 different methodologies in which you can assess the fair value of your startup or your company's share. And based on that, that tax will be calculated. But like fractional investing this morning, we thought, before we dive headlong into what is the latest news on angel tax, let's understand angel tax. These are oxymoron. It's an oxymoron if you ask me, because tax and angels have nothing to do with each other, if you ask me.
Angels and demons, rather.
Yeah, so to speak. So Kartik is here, and we have a very special guest joining us this morning. Siddharth Pai also joining us, this morning. Siddharth, thank you so much. Lovely to have you on the show this morning. Siddharth, if I were to come to you first, quickly tell us, what is the simplest way to understand angel tax?
So angel tax is simple. It's actually an anti-abuse measure that was introduced in the Finance Act, in Income Tax Act in the year 2012. What it actually does, it looks at anytime a private company ends up actually issuing shares at a premium that is above its face value. What the tax department does, tax department looks at the issue price, the price at which actually given shares to investors, shareholders, etc., versus the fair market value of those particular securities. And any difference between that is actually taxed in the hands of the company as angel tax. So even though it's called angel tax, number one, it doesn't apply on the angel investors. It actually applies on the company. And number two, it is in form of capital tax. Income tax is actually paid on income, but India is unique in the sense that we're taking capital receipts, which are investments, and we're taxing them as ordinary income also. It's a very Indian innovation that's actually come in as an anti-abuse measure. And it came in because in the year 2009, there was an alleged case of money laundering that actually happened. And the case is actually still being fought out in court as of now. So to prevent that sort of issue from actually becoming regnant in the ecosystem, the government in the year 2012 decided to actually introduce this particular provision, section 56 to 7B of the Income Tax Act.
Siddharth, let's just simplify it. You said a lot of things which make a lot of sense, but this morning I'm having my coffee. I'm a little slow on the uptake, so just simplify it for me. Angel tax is not valid only on angel investments. It is equally valid on venture capital investments. It is equally valid on alternate investment funds also investing in Indian startups, right or wrong?
No, so I think the angel tax, there are only 2 classes of people who are exempt from angel tax as of now. The first one are AIFs, your alternate investment funds regulated either by SEBI or IFSCA. And the second one is a little criteria for foreign investors that the income tax departments actually release. So in case you are a sovereign wealth fund, in case you're a banking or insurance company, in case you actually are let's say a private equity fund not registered with either SEBI or IFSCA, and you actually meet certain preset criteria, then your investments are actually excluded. Everybody else for that matter, be it a State Bank of India, be it an Infosys, be it a large HNI and everyone, any of their investments into these sort of startups can actually attract angel tax for that matter.
And what about regular venture capital flowing in? Let's say SoftBank or Tiger Global invests in an Indian startup above the FMV, and we'll come to the fair market valuation also, above that 10% cushion of the FMV, then these venture capitalists also are subject to, not the venture capitalists, the startups receiving funds from these VCs are also liable to pay angel tax on that premium above the 10% cushion?
It is actually possible as of now. If they don't meet the criteria given by the tax department or they're not registered with either SEBI or IFSCA, there is a chance that investment can end up actually attracting. A number of these funds aren't actually registered as AIFs with either SEBI or IFSCA. They prefer to have vehicles either in Mauritius, in Luxembourg, in the UK, etc., to make global investments itself. So some of their investments as of now, if they don't meet those particular rules, can attract angel tax in the hands of the company.
Okay. And how much is the tax rate? What is the tax rate? Angel tax, yeah. So give me an example. 10 CR valuation of a company, fair market valuation. And like I said, we'll come to the fair market valuation also. But 10 crore rupees, let's say, is the fair market valuation. Add a 10% cushion to that, up to 11 crore rupees, no tax. If you were to raise capital at a valuation of, let's say, 15 crore rupees, then this balance 4 crore rupees gets taxed at what rate?
That's right. It gets taxed at the rate for ordinary income generated by a company, which is about 25.17%, including the surcharge, the cess, and everything. So 1/4 of your capital raise goes away. But one very important point, what normally happens in these kind of scenarios is that what the tax department does is it compares the projections that you made at the point of raising capital versus the actual performance based on the audited financials of the company. And in case a deviation is significant, now about 10%, the tax department disregards the valuation report. So the entire capital raised by the company can actually be subject to tax. So in your case, the tax won't be on the difference between 15 CR minus your 11 CR for that matter. The tax will be at 25% of the entire 15 CR. So that's actually the heart of the income tax problem. It's not as simple, because the tax department on numerous occasions has actively disregarded the valuation report, saying that because of the deviation between the projections and actual performance, we don't believe the report is actually valid.
All right. So now tell me something. If this is the calculation, 25% on the entire capitalization and not just on the delta between fair value and the actual valuation at which money was raised, then why is it being rejoiced? Why are startups happy with this new development?
So startups were happy because they ended up seeing a notification, and I think there were some people on social media who didn't exactly go through the whole notification in great detail. I think the important part to note in the notification, it's unfortunate, everyone passes finger first when it comes to matters of regulation. It does a disservice to the industry. One thing to also note is the 5 new valuation methodologies that only apply to foreign investors. It doesn't apply to investments from domestic investors as of now. So if I'm an Indian startup raising money from domestic investors, family offices, HNIs, etc., as well as from foreign investors, I now need to create 2 different valuation reports with 2 different valuation methodologies, which just actually complicates the issue and doesn't contribute to ease of doing business. So I think the fine print is something that the ecosystem is looking at as of now, and they're slowly understanding what are the additional hoops they have to jump through in order to be compliant with this new regulation that got released yesterday.
So this FMV calculation, the 5 new methodologies you said are applicable only to foreign investors. But this calculation of FMV would be valid with or without angel tax, would be a valid tool to understand real market value capitalization of a startup in any case, right? So now help us understand, what are these 5 methods? Very briefly, I know you have a call at 10:45, we'll let you go, but very briefly, what are these 5 methods and what would be the difference in arriving at a valuation number using any of these 5 methods?
So I think that's a very good question, but I just counter that question with another point as of now. What happens no startup is actually valued based on a valuation report. Even there are noted valuation experts like Professor Aswath Damodaran of NYU, who's actually stated that young companies, because of a lack of operating history, because of uncertainty in operations, because of new innovative business models, cannot be valued using any of the traditional methods. And the 5 methods given are actually traditional methods. The 5 methods are your comparable company multiple. So let's say I'm in a SaaS company, another company is valued at, let's say, 50 times P or 60 times
Apple
P.
to Apple comparison.
Multiple over there. The second one is probability weighted expected return. So you actually end up creating a probability table. You decide, can this company give me a 3x, 4x, 5x, 10x, go to 0?
Present value of future cash flows.
That's right. So the second one is option pricing. Assuming it's an option, you use the Black-Scholes methods for that. The next is milestone analysis. So the company says, I'm raising, let's say, 100 crores. I can use it that in the first 1 year of operation, I'll generate 15 crores of revenue. Next year, generate 25. Create these kind of milestones and look at how they've actually reached that. The last one is replacement cost, which I believe may not be relevant for startups, especially because most of the startups are asset-light businesses. So the replacement cost of some of the tech, etc., is not the right method to end up actually applying. I think this is more for infrastructure companies and the likes itself. So 5 new methods, but the core issue of the comparison between projections, which are future-looking, and actual performance, which is a synopsis of the past, and actually disregarding the valuation report if the difference is high, is the core of the issue of angel tax that is yet to be rectified or remedied by the tax department as of now.
All right. And who puts a final go-ahead stamp of approval on the fair market valuation, depending on either of the 5 formulae that you may have used in arriving at that. Who eventually puts that stamp of approval that, yeah, the calculation is correct and this is the fair market value?
So the income tax rules have actually stated that a category 1 merchant banker regulated by SEBI, it becomes a final authority. He has to give you a valuation report signed by him for that matter, and that becomes a valuation, that becomes a fair market value of that particular company itself.
All right, that's Siddharth Pai there, breaking it down in the simplest possible terms. One of the most complex things to understand, angel tax, and we're not going to hold on to you anymore. We know you have another call. We're going to let you go. Great to have you this morning and hope to keep having you as often as possible. Siddharth, thank you so much for helping us decode what angel tax is. And of course, thank you, Kartik, and I'm sure you yourself have become a semi-expert by the time you were done, wanting to ask, figuring out what to ask Siddharth Pai about angel tax.